Hi, I'm Howard Lothrop, host of Echo Partners TV, and I want to talk with you today about what do you do once you realize that your asset liability reports show your interest rate risk profile going beyond where you'd like to see it. How do you correct imbalances? Of course, there are many ways to do this. Some of the traditional ways would be to use your investment portfolio. If you want to increase asset sensitivity, for example, you would sell off some of your longer securities or reinvest in shorter term or floating. That would increase asset sensitivity. That's a great strategy. It is a pricey strategy given the costs involved in moving in and out of securities. And of course, it's a strategy that's often recommended by bond brokers who would do more business. Go figure. The other extreme are derivative strategies. I'm going to give you a disclaimer right now. A big piece of my business is consulting with banks on applying derivative strategies, particularly with respect to the hedging fixed rate loans. However, if you ask my clients, I think you'll see that I'm more often than not, and by a wide majority more often than not, recommend that they do not use a financial derivative to correct an asset liability or interest rate risk imbalance. The reason for this is that while you can eliminate or minimize basis risk, and you can fine-tune your asset liability change, your interest rate sensitivity change very exactly with an interest rate derivative, you need to keep that powder dry. Save that for when you have a huge move or a frightening imbalance in your interest rate risk. If it's keeping you up at night, yes, let's talk about interest rate derivatives. So we've seen the simple cash market solution, and we've seen the other extreme, the more complex derivative solution. So what do? Well, actually the most cost-effective and efficient way to correct asset liability or interest rate risk imbalances at your bank is to do so organically with respect to your products and your pricing. So if you need more asset sensitivity, get less aggressive on your fixed rate loan pricing. Let some of those deals go away. Get more aggressive on your floating rate loan pricing. You want to add these assets, and these are going to be good earning assets at your bank. Adding or revising sensitivity through your organic product and pricing decisions, it takes a while. It takes some time, and it's akin to turning a battleship or an aircraft carrier. It takes some time to do that and to make it effective. But the reality of it is those sorts of organic and homegrown product and pricing driven changes are the ones that are going to drive the biggest long-term results for you in the bank. We'll see you on the next episode.